All right, super. We're going to talk about more real estate. It's hard to do that coming off of Peter Lewis's presentation, and we hope not to disappoint. I'm Ross Weiner. I'm founder of Gemsco Capital. Gemsco basically is a private real estate investment and advisory platform. We focus on commercial real estate, both as investors and advisors. We work with family offices, high net worth, and other funds and JV partners. Very agnostic as to categories. We look for opportunities, and we also look in alternative areas, venture capital, special situations, private credit lending, single family residential. There's some great panelists with us here today. Jiho Lee, who's here with Tishman Capital Partners, been with us before. They're family office investors. Really have a broad mandate, special situations, CMBS trading, opportunity zones, active in all areas of real estate. Also, we have Carol Pepper with us. She's the founder of Pepper International. She acts as an external chief investment officer for family offices, helps with governance and setup and restructuring, has been in the business a long time, very highly respected advisor and thought leader and speaker. And we have Peri sitting next to me with Union Investment Real Estate, which is a German open-ended real estate fund. He's responsible for U.S., East Coast, Latin America. They are more core type investors. Tal will tell you more about it. Focus on office, multifamily, industrial, hotel. So we have a little bit of everything from opportunistic to advisors. And I'll give a little bit of overview just as sort of, what we're going to try and talk about and where we are. This is, I think, the third or fourth panel that we've done for Marty this year. We've been taking the temperature of the environment for real estate all along. Where we stand right now is we still have a very severely inverted yield curve. The 2-year Treasury rate is close to 5%. The 10 years at 4.2 to 4.3%. These are like the highest rates that we've seen in quite a long time, maybe 20 years. So the question still remains: is the Federal Reserve done or not done with raising rates or keeping things stable? We also still have an inflation problem. While it's come down somewhat, it's ticked higher lately. We're not there with what the Fed and Jerome Powell want to do. Oil prices have really shot up over 30% in the last month. Got a combination of, now that the Strategic Petroleum Reserve has been drained and they're cutting off, drilling, offshore drilling here in the U.S. that Biden just announced. It's going to put more upward pressure probably on oil prices. And from a multifamily and housing perspective, we have 30-year mortgages at 7.5%, which is a multi-decade high. And I think it's been talked about, from our earliest panels today about, the drop off in the supply and volume of trading in single family because so many people have 3% mortgages and can't afford to sell, can't afford to move. And we have this big affordability gap. Last thing I'll reference before turning it over to my panelists is that as far as Manhattan, I know we're going to get questions about Manhattan and office buildings. Bob Knackel of Jones Lang LaSalle put up some interesting statistics earlier this week as far as Manhattan building sales, and this is across all categories over $500,000. Sales volume of number of transactions is down 20% year over year and down 57% from the 2012 peak. In terms of dollar volume of sales is down 36% year over year, 47% from pre-COVID 2019, and 72.5% from 2015 peak. So that gives you a sense of sort of, people either not buyer and seller mismatch and people sitting on the sidelines. So with that overview, I think we're going to let the panelists introduce themselves and what they're doing, and also talk about whether they're sitting on the sidelines right now, or if they're looking to invest, how aggressively they're looking to invest. So, Carol, why don't we start with you?
Oh, thank you. Well, my name is Carol Pepper. I'm the CEO and founder of Pepper International. And for the last 22 years, I've done two main things. I've acted as an external CIO to several large single-family offices. And I've also set up or improved the operations of single-family offices for families all over the globe. I'm on Bloomberg Television once a month calling the market. And I'm an advisor to the United Nations Capital Development Fund, UNCDF. And over the years, of course, my clients have always invested quite a bit in real estate. And you're right, it's a question of how long can we bear the pain of these high interest rates. There's so many people who, took floating rate debt, or they're in the process now. They finished construction, they're ready to refinance, and the money's just not there. Numbers that worked for many years are not working right now. So for the single family offices that I work with, I would say the international families don't really care short term. I mean, they're looking for, deals because there are a lot of properties going into distress. So there's a desire to pick up some properties cheap because they have very long time horizons. So for example, although a lot of people are selling in Manhattan, there are large groups of Europeans that are coming in to buy hotels in Manhattan in particular because they figure this is a good time to pick them up at a reasonable price. There's also a great desire, for example, for people from Latin America to park their money here in real estate for the long term, because although our government may have problems, it's nothing like what's happening in other parts of the world. And people are very concerned with a lot of left-leaning governments, and in other countries, they will seize all your capital and all your properties. So there's a great desire to put money to work in real estate in the United States generally. So I would say foreign capital is still coming in here and actually looking for some discounts. People are getting much more discerning, of course, which niches they look at, and we'll be talking about that later, sort of where some of the opportunities are. But I would say it looks awful to us, but if you're standing outside of this country, it actually looks pretty good here relative to the rest of the world. The strength of the dollar, the underlying strength of the economy that has resisted collapsing with all of these interest rates is impressive to other people in other countries where their countries are not doing so well, for sure.
That's a good point. Tal?
Sure. I'm Tal Peri. Thanks for having me. I'm with Union Investment. It's Germany's largest open-ended fund. We have around 60 billion AUM globally in real estate. In the US, we have around 7 billion. So we increased that from around 12 years, 2 billion to 7 billion, from one asset classes to 4, and from 10 markets to 17. So diversified into it. While I always like to say you talked about foreign capital sources. Our capital source is foreign, but with 7 billion AUM, we're considered a local player, and we're treated as such by institutions, by brokers, by intermediaries, by GPs. Definitely an extreme market. Thanks, Ross, for setting up the framework of where we are today. Interest rates increasing so fast obviously sets a question mark around pricing, right? And I just had an interesting conversation yesterday about someone, and I told them, what would you buy a certain asset class in a certain country, the big O, that office building that nobody wants to talk about. And he mentioned a very, very high cap rate. And I said, you also own a building. What would you sell that for? And it was a very, very different number. And so that sounds like a very simplistic story, but I think it's very, very true. And we all talk about the gap between buyer and seller expectations. There's a shift happening. We had migration that not many places in the world had. What we've seen, when you think about the US, it's almost it's more a continent than really a country, because you have one legal system that's helpful, and that's why from the outside world it does look very positive. Which country in the world has over 300 million and has one legal system that works? Nothing is perfect, but it is pretty functional. And the fact that we did raise interest rates by over 500 bips in less than 18 months, and unemployment rate is still so low, is pretty remarkable. And what I would argue is that whenever we're done with this, and we don't know when it's going to go back to a more normalized setup with interest rates and settling at a certain level, or even decreasing, hopefully, eventually, there's some underlying resilience and strength that I think we will see, and that's what almost the Fed is fearful of. So if you think about mortgage rates dropping down to 3% or 3.5%, there'll be a lot of buyers that are now on the sideline, not even considering buying a single family home. That will come back. I'm not suggesting that that's going to happen very quickly, but if that impact is too strong, and that's why there's more and more economists talking about a longer, higher for longer rate environment, because there's this fear of that strength being there. So if I drop it by a quarter bip, nothing's going to happen. If I drop it by 1% or 1.5%, well, some people are going to be active again, and that's what we have to maneuver through. We'll talk obviously about the panel, about all kinds of different asset classes. We're active in all major food groups. We've gone into smaller markets, a bigger market, and so happy to talk about all those different things and looking forward to the panel.
Thanks, Tal. Very interesting. Jiho, you're on.
Thank you. Good to see everybody. Jiho Lee. I'm with Tishman. Tishman is a fifth-generation real estate business family based in New York. We used to be well known for Tishman Construction, which we've since divested about 15 years ago. We have a family office that does endowment-style investing in stocks and bonds, external managers, direct deals. We also have a vertically integrated real estate operating platform that's been mostly active in actually hospitality. We own the Westin New York Times Square, Intercontinental New York Times Square, Swan and Dolphin Resorts, and Walt Disney World amongst our portfolio. And also we've been, as Ross mentioned, we've been an active special situations investor, not only utilizing our own capital, but also tapping into external network, having been successfully trading CMBS bonds in March and April of 2020, when the bond market had a little bit of a blip post-COVID lockdown, and also in 2021 we raised external capital for qualified opportunity zone investing. So we've been, opportunistically investing, utilizing our capital base as our main strength. Nowadays, we are contemplating what to do, especially on an opportunity cost of earning mid-5s, even 6s in investment-grade bonds, or U.S. Treasuries for that matter. So it's hard to kind of beat that from a risk-reward perspective. One mandate we do have is we have a relatively large 1031 exchange coming up in about 18 months on a structured sale. So we're really thinking hard about how to deploy that capital, focusing on all food groups, as Tal mentioned. One comment on the interest rate, which obviously a lot of people have been focused on, and as Tal mentioned, in the past 18 months, 500 bits or so of short-term rates have been increased. And a lot of distress we've been seeing has been impacted by that short-term borrowing costs having gone up, people having to go and buy rate caps or not being able to refinance their short-term bridge loans. What has been talked about a little bit less is the long end of the curve. We're still looking at, in the mid-4s of 10-year rate, which has gone up about 200, a little less than 300, just about 300 basis points up from, 18 months ago. How is that going to impact the cap rates on a go-forward basis? That's another area that we're really looking hard at, not just on the short end of the curve.
Do you think cap rates have adjusted enough?
On a high level, it all depends on where people's expectation of where that will settle. But just taking net lease market as an example, which should correlate as a spread to the 10-year curve for 10+ year triple net leases, while the 10-year treasury went up by about 300 basis points, the cap rates only have gone up by 100 to 200 basis points, which implies the spread has tightened by 100 to 200. So arguably, one would say it really hasn't adjusted as much as it should have, or it's baking into people's future expectation of 10-year would come down, and that's.
Or is it reflective of just so much capital out there still looking to invest? Like you said, you still have clients that are, particularly international clients, that are looking to put money here. Yeah. Are they just looking, or are they actually buying?
Yeah, I think international families are looking. They're kicking tires, but a lot of them are buying as well. There's a lot of private sales going on that do not hit the broker market. So one of the requests I often get from people is, do not introduce me to any brokers. They're obnoxious. Do you know another family office that wants to sell something? So when I have somebody looking to buy, I call other family offices to see what they want to sell so that we get rid of the whole broker noise in the middle. I don't know if you find the same thing, but that's basically, you know, one of the tricks for family offices is trying to kind of maneuver around the whole broker in the middle thing, because often they're the ones who queer a deal because they're greedy. So if we can get rid of that and have families that have a similar, you know, values or what they're looking for long term, often we can make a better deal.
I think to be
Sorry,
fair,
big question.
Sure, just curious,
Sorry.
but Carol mentioned the issue of expropriation with international families. And I was just curious from the international point of view, I suspect there's a lot of international pension funds that you deal with, and perhaps that you and so this is not a big risk. You're like, for more, would there be more international pension funds overseas, Western Europe, coming to the States? And what about Canada? Is that another market that, again, given the regulatory environment, rule of law, et cetera, that people is that something else that you do? Latin America and Middle East, et cetera?
yeah, so a couple of comments to what you said, Carol. I mean, first of all, to be fair, they're very professional brokers that create high-level value. We have put more deals on the market. We always use large institutional brokerage firms, and I can tell you that on the institutional side, in a normal functioning market, creating a market, getting people to bid, you'll be surprised. In the last 3 to 4 very, very strong bidders are outbidding each other. And I've been on both sides of it. Sometimes there was nobody around. There's 1 or 2 Germans fighting each other to win a deal that they really like. And the capital source is similar, and the capital cost is maybe potentially in a certain time cheaper. And so brokers can create very strong incentive to and earn more than their fair share in that market that's fully functioning. On the other side, which is very hard for brokerage firms, when the market is dislocated, they spend a lot of time, you know, dealing with clients and don't get compensated. So they have that other part of it, and they have to build it up. So I don't necessarily agree with that idea. I do understand and agree. We know that currently there are more off-market transactions than you have than in a functional market. And so off-market transactions allow a certain cutoff. And one of the main reasons why many families that you deal with and that I talk to, they're more active now because the capital structure is different. A big fund, including ours and other open-ended funds, or even big closed-ended fund that still have to deal with whatever they bought at low cap rates, an environment that just run away, right? So we have to deal with a big portfolio. You have to manage your risk. And while a $60 billion fund has a lot of free liquidity, we have to manage both sides of it, potential redemption, capex topics. And when you're either a fresh new fund, like $30 billion Blackstone, for example, right? No baggage, starting fresh, you buy something at an 8 cap, it is an implied 8 cap. If you're a fund that is closer to a mid-4, buying something at an 8, but you have 20 billion that averages that out, it doesn't go up that much. And so on the family office side, multiple groups that have income from other businesses, if that's very lucrative, they're coming in with a different perspective. It's a 1031 exchange you talked about, sort of different way to look at it. And so it is quite interesting that in today's world, even institutional type assets, including the one that I office in, 1336 Avenue, just one example of a trophy class A office building that used to be owned by RXR and Blackstone, very institutional group, is selling to a syndicate of multiple families. And it shows you where the market is, and it shows you also different actors. So when you talk about foreign groups, Latin America, Europe, Middle East, United Emirates is an interesting place, especially because they're also linked to the US dollar. So their currency doesn't have to deal with the US dollar, euro hedging costs that European investors like us have to deal with. So some years our funding costs are much, much cheaper. Sometimes they get more expensive if you factor in the hedging cost. And so a lot of those actors on the private side are really, really strong. On the institutional side, it really depends on the fund structure, similar to what I described. How big is their existing portfolio? How are they diversified regionally? And what asset classes did they have? And this world has changed so dramatically that classes that used to be as a full asset class are very positive, and in the ranking on the top 1 or 2 have shifted around. And I think what's very important in this current environment is to really decipher very specific, like not linear development. Migration went all to Miami. They went to Phoenix, and Phoenix and some smaller markets actually have seen people move back. Companies like Zoom and others, even those that are saying you could work remotely whenever you want, are starting to at least tell people to come back 3 times a week. If they don't have an office in that location, that means you need to go back to wherever there's at least some kind of office
Well, that's
space.
a couple interesting points there. That some of the recent data that's come out has suggested that a lot of the migration that we've seen has slowed down dramatically to the southeast and the southwest. And then with people coming back to the office, well, a lot of companies are requiring people to come back more. There's a question, I've heard this, view that, one of the reasons that they're doing this is trying to get people to basically self-terminate as a way that they don't want to be seen as firing people, and they want people that don't want to come back to the office then to say, I don't want to come back to the office, so I quit. And have you seen any of that or heard?
I've also seen a couple of articles. I think that's typical for we're not in a recession yet technically, but that's typical for any downturn. In 2008-9, we had many companies that said, oh, we're firing X% because of the financial crisis, but it could have been all kinds of reasons that were there before, they were lingering, and it was a very good excuse or time to do that without getting a lot of backlash, right? But I think this phenomenon is serious and real, and it's continuing to evolve. We don't know where it's going to settle, but I personally think hybrid work is here to stay. I think that very few companies will survive in a fully remote work, and I would argue that fully remote workers in the US are competing with fully remote workers anywhere in the world. And so that's a risk of being outsourced into Latin America, into India, into lower income countries with very high degrees. You'll get a Mexican or in Argentina, very, very well educated, sometimes US educated people that go back that would have just different expenses.
I guess especially in tech, distributed workforce is just a reality. And I think a couple of companies announced it, back to the office, and people are just quitting left and right, saying that they've already moved to Texas or Florida, and if I'm not moving back to California, no way. I mean, seriously, right? Or why pay the taxes in New York, etc. So, I mean, in some verticals, it's tough.
To actually address this gentleman's question earlier about the foreign capital, for at least what we're seeing is it's more families that have less baggage already or have a very long-term horizon who's able to take advantage of what they seem as short-term price dislocation, whereas a lot of the institutions who've been active in the US, they're actually kind of limited because of the baggage they currently hold or hedging costs or et cetera, as Cal mentioned. In terms of Canada, actually a lot of groups are looking at Canada as a potential alternative to the US as being that developed world, Western world with English as a main kind of language. And so the markets like Toronto and Vancouver have continued to attract a lot of capital driven by immigration, and that's actually been really supporting their market quite nicely. So
I'm just curious.
And to go back
if I'm Shell, Shell, and I'm doing asset allocation sitting in another part of the world, do they put money out a lot to the U.S. real estate, Canadian real estate, or others? What's their sort of general allocation? If I'm one of the big corporate, it's traditionally been a lot of bond investment.
I mean, U.S. is obviously one of the strongest countries in the world, one of the strongest real estate markets in the world. But to be specific in terms of country allocation, when you talk about Latin America, it's really so many different jurisdictions, countries, languages. But Mexico, for example, is one market we're active in that I can talk about more education, as a more educated person that transacted there. They have quite a lot of interesting opportunities in their country right now.
Yeah.
They have the nearshoring we talked about, as Carol and I just before, as a preparation here. The nearshoring in the industrial space, in the top 5 industrial markets, you have less than 1% vacancy. A lot of companies, including Chinese companies, are coming over. The hospitality space, resorts are at all-time high performance. Not only, but a lot of American And so and there we talked about fixed rate, and where that is, you talked about bonds. Their Fed rate equivalent is at close to 12%.
Yeah.
So if they get so they could get close to 12% by just a 1-year fixed income product. And so coming into the US, buying something at a 5 or 6 cap is kind of something they're also trying to struggle with to figure out, is that where to be in. So it's.
And there are other long-term trends that also, family offices are looking at with respect to Mexico. So for example, if you look at how much retirement savings, I think 49% of Americans have less than $10,000 in retirement savings, but there are very industrious groups building incredible retirement communities, for example, that will be cash flowing for people to move to Mexico and live on their Social Security, where they can do it very nicely, have a beautiful retirement, versus staying here and having to work at Walmart when they're 85. So there are other big trends that you can capitalize on besides the working from home. There's the massive number of boomers who are starting to retire now that don't have savings and that need affordable housing. And Mexico is a very interesting market for that. So that's another area that people are looking at.
You talk about Latin America and investing in Latin America. Do you take into consideration the government and what, the turmoil and the turnaround that happens over there? Because what I find, and I'm with the Latin Family Office Society in Miami, what I find is that some of the high net worth families in those countries are looking to invest here because of all the turmoil in their countries and the uncertainty. So I was just wondering, is that a factor when you look to invest your money into those countries? Mexico being a prime example? Well,
sometimes it's a different family, right? The Latin American families absolutely want to get their money out of any country where the government is going left. The government's drifting left, they're terrified, and they all want to take the money out and potentially even get a second passport to be able to leave physically. So many, many people in Mexico are getting a second passport. There's a drift to the left. They're kind of watching it. They're nervous about it. But there are other people here, for example, in the United States, who are realizing nearshoring is coming. People are pulling back businesses from Asia, putting them here after what we just went through and with all the tension we're having with China. So there's kind of different groups of investors going in different directions for different reasons. But I would say the Latin families absolutely are bringing their money here. That's one of the comments that we opened with. Yeah.
The capital controls from some Latin American countries, what's the government doing in some of these countries that capital controls? So, you can't take away.
I think that's a little too detailed for this.
Oh, yeah, okay,
for this panel. We want to focus on real estate, but we can talk about it afterwards.
We've got about 10 minutes, guys.
Okay.
Yeah, sorry, you were going to say something here.
No, ultimately, one of the things about foreign capital coming in, size also matters.
Yeah.
If you're a large group, where are you going to put out $1 billion in one transaction? Trophy New York office.
Yeah.
Or Chicago.
Mm-hmm.
Sure.
I'm saying a Korean pension fund bought, was it Water Tower or Sears Tower? One of those places, right? 8 years ago.
There's another trend that, everybody moved out to Phoenix, but suddenly they didn't count on the fact that it was going to be over 100 degrees every single day in the summer. So there's also going to be if the climate continues to worsen, there's going to also be something to look at in terms of retrofitting the buildings, making these places habitable. There may be large parts of Texas, Arizona, and Utah even, which will not be habitable within 5 or 6 years. So be careful just putting all your money down in the Southwest, because it'll be underwater in Florida and it'll be burned out in the Southwest. So people will come back
at the same time.
On that
Never mind what the taxes are.
That's another
You
panel.
won't be fried or drowned.
that gloomy note, maybe we should invest into Mexico.
Okay. So, Jiho, do you want to sell hotels to Carol in New York, or?
We're always open for a discussion.
I can broker that deal right now.
There's a price for anything, but what I can also tell you is 0 is sometimes not cheap enough to buy.
Yeah.
It seems that, sort of the consensus still is that interest rates are going to stay high, inflation's going to stay high. We don't know for how long, probably into at least next year. That's going to result in, continued dislocation. We don't know how severe that'll be, or if there'll be any other shocks, like we had the banking crisis for a couple of weeks in March, whether there are more shoes to fall on that. So a lot of people are still in a wait and see mode. And I think that's probably going to continue to be the case. Transactions will happen. There's pockets of money all over the world, both here, domestically and internationally, that will still try to invest in real estate if they can find the right assets or the right opportunity or the right pricing. And but still, there's a lot of wait and see. And you can see that in the volume. You can see that in home sales volume. You can see that in commercial property sales volume. You can see that in brokerage company stock prices. If you want to go online and look at Walker and Dunlop or Newmark or something like that, you'll see how their stock prices have performed. Wait and see. Anybody else want to ask some questions of our panel?
I would also say that there are some fantastic niches that are doing well and are not necessarily as interest rate sensitive. So for example, self-storage. Self-storage is exploding. It's starting to be rolled up. It's getting to be a more professionally run asset class. And you can make good money in some of those self-storage funds.
I want to actually I don't want it not to push back on that. And I'm not that up on self-storage. I was running some charts last night on different REITs. I didn't really want to bog this panel down with presenting them. But one of the self-storage companies I was looking at, which is Extra Space, as sort of like a proxy for the industry. Let me just find the chart here. I mean, it's down like a lot. I was surprised because I thought that too, as far as self-storage. I mean, Extra Space had a high of $215. It's now at $126 a share. And part of the reason, I did some research on this last night, part of the reason that they're attributing to that is that self-storage performance is tied to a degree to the housing market. And that to the extent that there's less activity in the housing market, less people moving, less need for storage, in terms of growth anyway. I mean, it's still, they keep raising my storage unit prices every year. They don't care about that, but that it's tied to the residential housing market. And that's one of the reasons why the stocks in the sector have cooled off in terms of pricing growth and transaction volume and stuff like that.
Well,
About 5 minutes left?
Right? With that?
5 minutes?
Yeah.
What signs are you guys looking for when you think the market's bottoming
I think a big part of this is obviously having to work through some of the foreclosure process, loans that are coming due that are not going to be extended or will be extended at different rates. So you obviously need some kind of stabilization on the interest rate environment by the Fed, right? It's going to take a while until they go down, but at least if we're certain that they don't go up as much. And then you really have groups that still have equity in their deals. They're going to keep on postponing because they don't want to sell at the loan or below loan value. And so I think to watch out is transaction volumes, right sizing and write downs of major REITs or bigger companies that can be tracked. On the private side, it's hard to see because you won't know, that data is not available. And eventually when the price equilibrium is there, that people are just starting to sell assets at new pricing, not at old pricing, and accept that that is a new reality. I think that's the point where bigger institutions are going to come back and also have to do whatever necessary on the write-downs, but also start to get new fresh capital in for that. And with that, you'll get a little bit of rent growth. And one thing in that context that I would recommend to watch out for, people say like, we don't know when interest rates will come down, when cap rates will come down. Cap rates are not just driven by interest rates. That's a major factor, but there's two things going on right now. First of all, the fact that institutions have withdrawn more and family offices are more active means that the higher cost of capital is driving cap rates up just by who the capital players are. So at the time when all these institutions that are more careful and less active, when they feel it's time to get back into the game, you have a flood of cheaper money coming into the system, and you have some form of cap rate compression, even at a very similar interest rate environment, just by different actors being active. And that's an interesting trend to watch. And I think if that happens, and when it's going to happen, when that happens, it may happen fairly quickly, because all of a sudden it's going to be like 2021 in terms of if I don't buy this now, it's going to get more expensive. It's not going to get cheaper. And that's when you will start really like this snowball effect. If people feel waiting is not going to get me to get a cheaper deal, I'm going to get a more expensive deal. That's kind of what I would look for.
A little bit of a counter to that is there's, similar to how we are looking at bid-ask spread, the seller expectation versus what most buyers are willing to pay. Right now, there's a lot of standstill, but to Tal's point, there are some groups that are coming in that has lower cost of capital who are clearing that bid-ask spread. There are certain asset classes like suburban offices where that bid-ask spread may not tighten, then it'll break. And that could have an impact on a broader market. So those are kind of metrics we track. One thing to talk about in alternative niche asset classes where we think it's either counter-cyclical or non-cyclical, where we think can be interesting throughout different market cycles, such as manufactured housing, affordable housing, these type of asset classes. One thing we will emphasize is it's all about access. They're niche for a reason because it's not widely available. There's rarely publicly available source to access those deals. And that's when we really value the partnerships of on-the-ground operators. Sometimes they're investment sales brokers that we trust and advisors like Ross that we work with. So that's sort of in this moment in time where we really have to stretch to find that right partner to get access to these niche opportunities.
And it really depends on the type of capital that you have. In my case, one of the impediments to buying, properties right now is the inability to get positive leverage. So if you're an all-cash buyer, you don't have that problem. But if you're a buyer that needs to leverage your returns to get acceptable returns, and you can't finance appropriately, whether it's loan to value and the pricing of the debt, it becomes a little bit more problematic. And I don't know when that's going to change.
Can you guys talk about signals we should be looking for like the office market collapse, housing, single-family home collapse?
Well, one of the signals,
like
I mean,
just want to make one remark. After 2008, I got a portfolio of half the hotels on South Beach at 50%. Right? Is that going to happen again? Jiho, you're probably an expert. Signals?
One of the key things I would look for is actually where the construction cost goes. As part of, the intrinsic value of real estate, it's a capital-based, asset class where there's an intrinsic value of replacement costs. So that's why construction costs act as that, the floor for what the intrinsic value ought to be. Because of the construction costs having been elevated so much, even when the price comes down a little bit, it still might be.
We have to move our call to Wednesday, to Thursday, because I'm not around. I think we have a call tomorrow.
In this environment, sometimes new development still makes sense because relative to buying an existing product, the costs might make sense to do.
I think there's guys that have really healthy balance sheets because leverage is just, there's so many businesses that are over leveraged because of the low interest rates for so many years, right? So.
But to answer your question about that kind of level of distress, buying 50 cents on the dollar type properties, I think that's going to be very difficult unless you have major shock to the system, like the kind that Darius Dale was talking about earlier, or another COVID, shock, not just COVID cases going up, but, something very severe, or, more bank failures, something that they can't fix in the short term.
Yeah, so I don't think like Lowe's and Fountain Blue and Edenrock are going to go on sale again at 50% off.
Probably not.
But if the but the Airbnb law goes to other cities, it's going to be pretty destructive. So like 60% of all the homes, apartments on Brickell Avenue in Miami are non-owner occupied. Yeah, they're all rental.
Well, I think the other thing to keep your eye on is how long do these interest rates stay at a high level?
I think it's going to be a while.
Yeah, because there's a lot of talk about the fact that there's many middle market banks holding massive amounts of real estate debt that can't afford to just take the keys back. One thing if you're JP Morgan, but if you're some middle Atlantic bank, you cannot take the keys back from 25 buildings and still be a solvent bank. So that's something we have to keep an eye on. At what point are they going to start giving a little bit of relief? Because it's not going to be so easy to weather this amount of high interest for another year. I'm not so sure how long the banks can keep pushing the loans or extending the loans down the line, hoping that they don't have to write them down.
This affects also their ability to write new loans, so, I mean, why
Yeah.
Yeah,
why
I
you
mean,
can't get
I wouldn't want to
financing.
get to a bad bank situation,
Yeah.
right, where, what you had before.
Yeah. Sorry, you had a comment?
There's been a lot of work behind the scenes, there's a lot of express money waiting, kind of coming slowly,
Yeah.
carefully. There's a lot of groups kind of sell out little pieces, I've had stuff come to these little things, and they're like, oh, we're selling this over here, we're working there. They're kind of like just slowly leaving it out, and there's a lot of capital still waiting. And there's a lot of pricing that's not bad in certain situations. Again, your time horizon makes a big difference. And, if you will rework it, can recapitalize it, restructure it better. But there's still some situations out there that are not bad. Again, there's certain things you want to avoid. Is everyone's like Class B and C office in New York and stuff. I mean, someone bought a huge building in San Francisco about 5 months ago. Because they were like, we'll wait 10 years, eventually they'll figure it out, and they got it for less than construction costs. Why not?
Yeah, that's a great.
That's a great point.
Time
That's
for
what,
one last question?
that's what family offices can do. They can think more creatively. Yes?
So we're seeing quite a few, like, real estate credit companies, we can provide that kind of, you guys seeing?
Yeah, I'm actually involved in some transactions like that, doing some private credit transactions here in New York on multifamily. So there is definitely some of that because you have developers that have built, condo projects or just straight on, rental multifamily that either haven't finished construction or they've sold, some of their inventory of condos but still have unsold units and want to get liquidity or have liquidity for another project and don't want to fire sale it out. And the banks that they borrowed from are out of the market. And, so there's a whole market that's developed. It's very expensive money. So it's kind of like a double-edged sword for, the developers, but, they have their own reasons as to why it makes sense for them to pay, high cost money rather than cut their condo prices by 20%. Because they don't, if they cut them by 20%, then they go to finance another project, their numbers won't be accepted by the lender. They won't be able to borrow money as easily because they have a history of, not being able to support their prices.
I'll talk about just quickly two things on that point. One is, as a lender, you always want to lend money to those who don't need your money. In this environment, it's the exact opposite. You almost wonder, why are you taking my money when it seems like it should be creating negative leverage? Sometimes they're desperate, that's the last option, which is, which makes the opportunity appealing in terms of you can earn potentially high return, but the key operative term here is potential. The second thing is volatility is the lender's worst enemy. You never benefit from volatility as being a lender. We are likely in one of the more volatile economic, period. So from our perspective, certainly there are opportunities here and there where we think we can earn an attractive risk reward, but on an overall opportunity set, the borrowers we look at, we shouldn't be taking our money, but yet the opportunity